Banks raise funds from equity and debt. Some of these funds are allocated into loans and trading assets. These activities generate some income. Other funds may be invested in fee-generating business lines. After interest and non-interest expense are paid, whatever is left over is called profits. Profits are nice in some years and not so nice in other years. The owners of the bank, the shareholders, have a claim on those profits. In this session, we will cover 3 important measures of bank performance: stock returns, return on assets, and return on equity. We will discuss how bank borrowing, which is also known as leverage, allows banks to boost their profits. And we will take a look at these 3 performance measures in the context of JP Morgan Chase, as well as the industry as a whole. When we think of performance, stock returns are usually the first thing that comes to mind. I invest $100 in JP Morgan common stock on December 31st, 2015. JP Morgan is a publicly traded bank, so I can buy this stock on E-Trade or some other trading platform. Assuming that I hold the stock and reinvest the dividends, then 5 years later, I could sell the stock for $225. Since the bank has performed well, its stock has appreciated in value. JP Morgan has outperformed the KBW Bank Index, which includes other US publicly traded banks. JP Morgan has outperformed broader indices of financial and non-financial firms as well. Are we done? Well, not quite. There are 2 issues. First, not all banks are publicly traded. And second, focusing on stock returns doesn't tell us much about why banks are performing well or performing poorly. To make progress on these 2 issues, we will examine the accounting performance in addition to these stock returns. Here is JP Morgan's income statement data. There are 2 key measures of accounting performance shown here and here. We have the return on assets, ROA, and we have the return on equity, ROE. They tell us about bank profits and can be calculated for any bank, publicly traded or privately held. Return on assets tells us how efficiently a bank puts its assets to use, how much after-tax profit is generated per dollar of investments. Banks that invest in assets yielding high returns and minimal losses, banks that borrow at low costs, banks that run operations tightly, banks that are able to minimize their tax burdens, these banks will have higher after-tax profits. There are many factors that can impact the ROA. Here we can see a couple. The overhead ratio measures cost control. Credit quality metrics say something about realized and potential losses in the loan portfolio. Bank shareholders are more interested in the return on their investment. This is given by the return on equity, or the ROE, which is the ratio of profits to equity. We can rewrite the ROE to show its direct connection to the return on assets. This additional factor here is what we call the leverage ratio. Alongside each dollar invested by the owners, the bank also raises some debt to finance its assets. The leverage ratio captures how much borrowing is going on. Higher leverage means less equity is used to finance each dollar of assets. Higher leverage means more borrowing. If a bank is fully financed by equity, then it will have a leverage ratio of 1. In this case, the ROE and the ROA are the same thing. Whenever a bank borrows, this will increase the return for the owners by a factor of capital L. Here is JP Morgan again. We can see the ROA of 0.91%. That doesn't sound like very much. Alongside the ROA, we have the return on common equity of 12%, much bigger. Why is the ROE so much larger? The answer has to be leverage. Down here we can see total assets and common equity. Roughly speaking, This gives us a leverage ratio of 13. For every dollar that common stockholders kick in, the bank borrows $12 to finance its investments. This levers up the ROA by a factor of 13 and gives us a ROE of 12%. This is one of JP Morgan's headline measures of performance. Let's take a quick look at the performance of US banks in the last 25 years. This is based on financial statement data collected by the Federal Deposit Insurance Corporation. First, we have the average return on assets. For a typical bank, it was around 1.2% before the 2008 crash, and then lower, around 1% once the economy settled down between 2010 and 2020. Let's focus on just one cause of bank profits and see how it relates to ROA. The blue line shows the ratio of loan loss reserves to total loans. This is a measure of potential losses in the loan portfolio. When loan loss reserves spike up, this means loans aren't doing so well. Since bank assets mostly consist of loans, there is a clear negative association with ROA. Let's layer on the return on equity. What really stands out here? The numbers on the vertical axis, right? In good times, when the ROA is hovering around 1.2%, the ROE is as high as 15%. This tells us that leverage must be about 10 to 1. This high leverage amplifies the ROE in good times, but it makes the crashes much more dramatic. We can see this in 2008 and also in 2020. Let's wrap up. We covered 3 important measures of bank performance. Market-based measures are informative, but they are only available for publicly traded banks. Accounting measures. We examine the return on assets and the return on equity. Both can be calculated for any bank. These measures tell us how banks turn a profit. Did the bank make great investments and keep costs under control, or did the bank take on lots of leverage? One final thought. We have been completely silent on risk. Making a 15% return on equity is all good and well, but what if those returns are fragile? As investors, how should we think about risks? As bank managers, what can we do about them? This is our next order of business.